Hello, everyone. Welcome to the Board While Waiting show. Just 3 days ago, we crossed the 200K milestone, but we're down a whopping 13,000 since then, ending off the week at $199,042. In today's episode, I'm going to talk about what happened to the markets and this portfolio in these past week. Also, I'll talk about what to do during down markets with specific examples from Netflix and Mercado Libre. Last Friday, the S&P experienced the largest single-day drop in 2024 so far. This was likely because Iran launched missiles at Israel, creating geopolitical tension in the Middle East. Screenshotting the bottom left picture from another YouTube channel called 1M65, which is one that I follow. The interesting thing is that Iran actually announced this missile launch in advance, almost as though it was planned to minimize casualties. The consensus over last weekend was that the conflict would be over and Israel would simply take the win of successfully defending the attacks and not respond. So everyone thought, hey, the market's gonna recover fine on Monday this week and everything was gonna be okay. But then Monday came and Israel instead said they would respond with force, and the markets didn't like this. And sure enough, just yesterday morning, they struck Iran, continuing the tensions in the Middle East. This Middle East crisis doesn't help because it introduces inflation risks through potential oil price hikes, adding fuel to the Fed to continue dialing down rate cut expectations. Then in the same week, Netflix, which is one major component in my portfolio, posted a great earnings result, beating top line and bottom line estimates and adding 9 million subscribers in the first quarter alone. But again, the market went down massively, totally unexpected, and it went down by as much as 10%. Some say it's because Netflix announced that they would stop reporting on the number of subscribers starting from next year. And people see that as being suspicious. Why Netflix crashed after such good results, we will never know the real reason. So, what can we conclude so far about the Israel Iran war, the actions of the Fed, the market, unexpected reaction to Netflix's recently reported results? The answer is this: it is simply impossible to predict short term price movements. So the question is, if you can't predict what happens in the future and how the stock market reacts, how do you know when to buy a stock in a down market? Now, the key takeaway I'd like all of you to have is this: when you're buying a stock, focus not on predicting the next immediate price, but on the price that has already happened. Let me give you an example by going back in history to when I first bought Netflix. So around July 2023, this is a chart of Netflix. I began researching Netflix stock and I was patiently waiting for the price that I was comfortable with. So I came in around, well, I hadn't bought the stock yet, but I was starting to look into the stock around here, right? And it started to go up a lot. So let's just pretend without the knowledge of hindsight, let's just pretend that today we are here at this point and we're just simply waiting for the prices, right? So if I just slowly go one day at a time to the right, slowly, we can see the price suddenly gaps down. Probably there was a bad earnings result from what I remember, or at least something that the market didn't like, that was unexpected. So what I'm trying to do here is to shield the prices for the next day so that we simulate that at any one point we don't know what the next price of tomorrow will look like. And we're just going to move the price along. So the price was at a high over here. And then in July, coming down to August, and I remember that when it was coming around somewhere around 416, this was about the price that I was comfortable with entering because it was selling below intrinsic value with a good enough margin of safety, in my opinion. At the same time, Netflix was still experiencing some pessimism from the reduction in subscribers that was reported some time back. So at this time, the price of 416 has already happened. I want you to pretend that you are standing right here at this point in time over here, and you've waited patiently since a few weeks ago, and now this price of 416, or this current price, has already happened in real time right now and is sort of in the past. So if your thesis is that the business will do well over the long term, then this 416 price that you've gotten should eventually go up in months or in years to reflect your analysis. So we continue moving forward. This is what happened day by day. We're just going to fast forward. It goes up, looks good. Goes up, goes up, goes up. Very nice. And then suddenly it starts to go down like a lot. Like it's going down to 300 plus. Right. So it doesn't matter what happens here in September. I could never have predicted this next immediate downward movement after I had bought in earlier at 416, right? If the price continues dropping, so be it. And if I have spare cash, which I remember at this point in time I did, you can average downwards. Because what I remember was that I averaged in another entry price somewhere around 377, somewhere here. So imagine I came in here, all this going up and down, and went all the way down, and I bought another entry at 377. Because obviously this is a better bargain than 416 that I got in earlier. So the point is that, do I regret making the first entry into 416 previously, a couple of weeks ago, right? The answer is no. Because the question you should ask yourself is, are you comfortable with the current price valuation? Because the price has already happened. You're not predicting the future anymore. It is whatever price is presenting itself right here today, right? So if we fast forward all the way to present day, all the way, this is where we are at today. And again, the same idea. We have no idea what the subsequent price action is going to be here in the next few weeks. Does it matter? It doesn't. The most important thing that matters is, are you comfortable with today's price valuation that has already happened? In my personal opinion, I think Netflix is still above fair value based on some DCF calculations I performed. It's still too high for me. But if for you, you are comfortable with this price based on your own valuation methods, don't regret this entry that you are making, even if the price shits downwards in the next few days or weeks. Because if you're like me and you believe in Netflix as a business long term and your thesis hasn't changed, then eventually, over months or years, the price of the stock should go up in line with the business. Now that I have equipped you with the psychology of not regretting comfortable entry prices that you've assessed based on your own criteria, and not to focus on the next immediate price action or trying to get the bottom. Now, what other strategies can we have to manage a down market? Firstly, it is important, in my opinion, to have a watch list of stocks that you don't already own. These stocks should be within your circle of competence. For example, maybe it's related to your career, your hobby, or products that you use every day and you have an intimate knowledge of. For example, Instagram, YouTube, Netflix, etc. The watch list of your stocks should each also have your own predefined price levels that you've prepared in advance that you are willing to buy at with no regret. The next thing is very simple. All you have to do is wait patiently for discounts on the stock for them to reach your predefined buy levels. So there are two things that hopefully can help you in your waiting mental game. Firstly, understand that on average every year, if we look at the table on the right, historically the S&P 500 corrects 5% or more about 3 times per year, 10% or more about once a year, and so on and so forth. Corrections do happen. The market cannot go infinitely upwards. For example, as of today, the S&P 500 has corrected about 6% from recent all-time highs. So that could either fall into the historical average of 5% or more, or the 10% or more, but we'll never know. These are all just probabilities. When the wider market corrects, chances are the stock you are interested to buy would also correct. At any one time, there should at least be one stock that has been hit by individual bad news, a bad earnings quarterly release, or general pessimism for some reason, and is trading below fair value based on your own calculations. The best discount combination is when the wider market corrects and the stock has also been hit by individual bad news. The best example, Netflix right now. So if you're interested, there should be an opportunity if you wait patiently enough. This means that at any one time, if you have an extra, for example, $1,000 in savings, there is a high chance that any one of the stocks you have in your watch list can be going at a discount and you can deploy the $1,000. If the market doesn't correct, or if none of the stocks in your watch list present a discount, then you just simply have to do nothing. But if your watch list, as I mentioned, is very large, the waiting game should not be that long. Remember that Charlie Munger always said, the big money is not in the buying and selling, but in the waiting. And in this case, I believe that waiting to enter a stock at a meaningful discount is very much in line with this philosophy. Remember that most of your gains are gained when you enter the stock. So, apart from waiting to enter a stock that you don't already own, what if a stock that you hold currently, for example, in the case of this portfolio for Netflix, corrects massively, like 10%, as in the case in the last 2 days? The answer is very simple. If your long-term conviction on the business hasn't changed, then your holding shouldn't change either. In the case of Netflix, despite all these huge drops this week, my thesis has not changed. Remain long-term optimistic, but of course be wary if the fundamentals change. In the case of Netflix, from my opinion, nothing has changed. The company is still growing, everything is still very good. With Mercado Libre following the tax hit in the recent earnings report, coupled with the wider market volatility from the Israel-Iran conflict, I've actually begun averaging into the stock new capital at 1500 and then 1420. As of today, the stock has already fallen further. If you look at the chart on all the way to the right, down to 1356. Will it fall next week? I don't know. I cannot predict the short term. But my long term plan remains the same. Do I regret the 1500 and the 1420 entry prices? No, I do not. Because I personally believe Melly is already trading below fair value now, and I am comfortable with all these prices. If the price continues shifting downwards, I can either consider averaging more if I have spare investable cash, for example, from next month's salary, or I can simply hold still and do nothing with the new capital that I've just allocated into this stock. It is likely that I will do nothing because at this moment, another consideration is that I don't want this stock counter to take up too much away from my target allocation of 15% for Mercado Libre. Latin America is an exciting region, but there are, of course, risks, as we have seen in Americana. There are always potential risks, and LATAM is still a very nascent market when you compare it to a more mature market like the USA. So for me, 15% as a target allocation is more than enough, in fact. And I may, of course, revise this in the future if better stocks with lower risk profile present itself. But for now, I'm happy with this allocation. So before we end the episode, I just want to show you the current fear indicator on CNBC. I have been looking at this indicator once in a while. I don't really know how they measure this. I'm going to think that it is a measure of maybe a combination of the VIX indicator plus probably like price action of the S&P. I don't know, but for me, this indicator has been quite representative of a lot of the price action and a lot of what I see in the market sentiment so far. And right now, it is presenting fear, which it hasn't been showing for quite a while since we began the AI bull run with the start of stocks like Nvidia and Meta all roaring upwards. So remember this before we end the episode. Warren Buffett always said, be fearful when others are greedy and be greedy when others are fearful. The thing I'm trying to say is maybe it is a good idea to start to look at some companies on your watch list that you are interested in as we start to re enter the fear territory. Thank you, everyone, and have a good weekend.